Stock futures taking a breather after the S&P 500 hit a fresh record high on Tuesday. Our next guest believes the AI story is still intact in tech, making it his most preferred sector within equities. Joining us now, we've got Jason Draho, who is the UBS Global Wealth Management Head of Asset Allocation. Jason, great to have you here in studio with us.
Great to be here.
So talk us through that positioning that you're identifying right now within tech.
So obviously DeepSeek was sort of disrupted some of the thesis overall for the tech story. But as we kind of step back and look at, I think, the big picture of like what that model entailed, one, it seems like it's really consistent with the developments in these large language models. It looked like it was a game changer, but when you look at kind of the arc of the development of these models, it's still kind of consistent with improvement, lower costs. That wasn't ultimately maybe the bigger game changer. And what we also saw coming out of the earnings season is that the big mega cap companies actually ramped up their CapEx spend. They know what's going on. It wasn't like this kind of caught them necessarily off guard. Yet despite that, they kind of ramped up their CapEx spending. So we're seeing a big increase this year in CapEx spending. The thesis is still very much in play. Maybe the winners and losers shake out a little bit, but the overall thesis, I think, is still on track.
So the AI-driven momentum rally, still on track in your view, but it seems like there's been this kind of rotation under the hood of the S&P. Yes, we're still getting all-time highs, but you're seeing financials contributing more frequently to that. Does that mean that there is a risk to some of those big tech names that's maybe not being fully appreciated by the market, because why not keep riding the momentum?
So I think like we've seen in the past year and a half, periods of time, a couple of weeks, a couple of months, where the markets rotated, you saw small caps do well. You're seeing European equities do well. Those have been under own when it's sort of sometimes the momentum goes that way, you got investors kind of chase it, but it's never really been sustained. And so I think one, you need the macro conditions to be very favorable for the sustained rotation towards value stocks, cyclicals, financials like that. So I think that could happen, but every time there's a bit of a hiccup, the tech stocks, these kind of mega cap names are the ones that sort of investors kind of go back to. I think that will continue to play out. And unless there's a real disruption in the earnings story, and thus far, we expect some moderation of earnings growth from incredibly high levels to still really good levels. So I think the thesis hasn't changed. So right now it's a little bit of kind of positioning the markets, a little bit of rotation, more so than a fundamental change in the overall story for either AI or the macro story in general.
It seemed like at the beginning of the year, S&P 500 earnings growth forecasts were largely in consensus at about 15%. Do you expect us to come down dramatically from that level, and if so, where?
Well, if you're talking about 2025, it depends also whether it's bottoms up or top down. I think the bottoms up analysts tend to be a little bit more optimistic, and those get kind of revised lower. Top down, we were at 9%. Based off of the earnings we can see for 4Q, when we're about 80% way done the season, might be a little bit higher than our expectation. So it just sort of shifts the level higher, but our expectation for the S&P this year is 270 per share for the overall index. That implies about an 8 or 9% earnings. Now the guidance we've got from companies for this year has actually been sort of coming down a little bit faster than typical. I mean, typically, companies kind of guide lower than they beat. We know how the game works. It's been a little bit more
sandbagging out there.
A little bit, setting the bar at a level they can kind of clear, right, comfortably. So that bar has been a little bit lowered a little bit more, but overall the story still looks kind of relatively positive for the earnings. So it just depends on kind of where your starting point is. We're still seeing close to double-digit type of earnings growth this year. Nothing in the guidance thus far suggests otherwise.
But it does seem like there's still a bit of disappointment from investors when that guidance doesn't come in and show continued record-breaking earnings growth. Are any dips off of earnings, let's say NVIDIA, for example, if they disappoint on guidance and there's a dip in the stock, is that always viable in your view for the big tech names?
Well, it has been viable. If you just look at what's been happening this far this year, retail investment flows and buying has been very, very strong for the first 6 weeks of the year. We saw it also in the tech space that when there was those pullbacks in NVIDIA, retail investors in particular were buying. So I think there's a buy the dip mentality. These stocks have done so well. I think a lot of people feel, if they didn't get in before, if there's a pullback of 15, 20%, that's a chance to kind of re-engage. So until there's a real crack or, significant crack in the thesis, I think those dips will be bought, not only in the mega cap names, but frankly, equities overall. I think that until those people really believe that the economy could roll over in some way, then any sort of pullback is great. Now valuations get a little more attractive and we'll put money to work. So I kind of think of it as there's an investor put in the markets. Anything that's, say for the S&P, like around 5,700 in that range, I think you actually get a significant amount of buying, sort of resistance, unless things look like they're really deteriorating in some way.
What about within fixed income? What is the pass through there as you're hearing from Trump administration that's banging the table about lower interest rates?
Well, it was interesting. About 2 weeks ago, Scott Bessent, Treasury Secretary, came out and said, when Trump is talking about interest rates, he doesn't mean the Fed, he means the 10-year Treasury, which is kind of, I have this idea of there's an other Trump put, not just for equities, but for Treasuries, which means you don't want rates to go too high, so you have to have essentially kind of a floor on the price of Treasury bonds, therefore a cap on interest rates. To have that, you basically can't have policy that's too inflationary. So in some way, it's sort of like, I think the bond.
It's difficult when you're also rolling out tariffs at the same time.
Well, so this gets into like a whole discussion of like, are they credible or not? How much of a negotiation ploy? I think the market right now still believes it's much more escalate to de-escalate, and they won't follow through. There is a risk that, of course, they do, that happens. But it was interesting when those tariffs on Canada and Mexico were announced on the Saturday of 25%. Monday morning when the markets opened, rates went lower, and they actually went higher when they were sort of pushed back for a month. To me, that's an interpretation. The market believes ultimately tariffs will be worse for growth than they are inflationary. The Fed will look through the inflation piece and much more about kind of growth slowing down. The uncertainty around it could cause growth to kind of slow quickly. And I think that's what the bond market, that initial 24 hours suggests that. So yes, it could be inflationary, but I think the market sort of view it as more of a growth hit.
But that might be a positive view for the market so long as the inflationary risk doesn't keep the Fed higher for longer.
Well, then you're balancing like what's better, lower rates for the markets or the growth hit. And I think the uncertainty at a minimum means you're probably like sideways, you're probably range bound.
Yeah.
Again, if the lower rates, if it's not recessionary, then there's only so far equities could sell off, but it's hard to get really, really constructive on equities as that's kind of playing out.
Really great overview, Jason. Thank you so much for coming in
pleasure.
studio with us. Really appreciate it.